Hello, welcome to Module 3. We've been talking about the role of banks in the monetary policy as well as the history of banking law. And today we're going to talk about some somewhat more modern banking laws. Just as a quick review, we talked in the last module about the National Bank Act, which created the Office of the Comptroller of the Currency, which is the federal agency that charters and oversees national banks. That was in the 1800s. The Federal Reserve Act was enacted in 1913 to create the Federal Reserve System and Board of Governors, also overseeing national banks, but the bigger economy as a whole. And finally, the Banking Act of 1933, after the Great Depression, to create the Federal Deposit Insurance Corporation, which builds sort of confidence in our banking system. And each of these laws came after or at a time of crisis. The National Bank Act, sort of during our early days of a country needing national banks and a national currency. Federal Reserve after some crashes in the stock market, and the Banking Act of 1933 after the Great Depression. And in more recent times, or somewhat more recent times, there have been three other major pieces of banking law that we'll talk about today. One is the Bank Holding Company Act of 1956, which I guess was a while ago, but still more recent. The Gramm-Leach-Bliley Act of 1999, which of course now is 24 years ago or more. But still a very significant piece of banking law. And finally, the Dodd-Frank Wall Street Reform and Consumer Protection Act, referred to as Dodd-Frank, enacted in 2010. And each of these laws was also enacted in response to some level of financial insecurity or problems. There was a recession in the 90s, and there was maybe something less than a recession in 2008. But certainly a financial crisis. But going back a bit more in history and to really understand banking regulation and what banks can and cannot do, we need to look at the Bank Holding Company Act, which was enacted in 1956. And prior to 1956, bank holding companies, which are basically just companies that own a bank, that's what makes you a bank holding company, were unregulated. And in the 50s, the world was starting to get a little bit different, and some single companies were wanting to own banks in different states. And the way the laws were back then, a bank could typically only operate in its own state. So a bank holding company might own a series of banks, each in a different state. It's referred to as chain banking. And at the same time, a company might own a bank, and it might also manufacture cars or do other things. And both of these activities were considered negative or potentially negative because there was a concern with banks crossing state lines, even if they were separate banks, but under the same holding company. There was a big concern with mixing banking and commerce. And there was just a concern really that these companies were getting too large. These bank holding companies were owning multiple banks. And as we see from the early days of banking, there's a real suspicion of mixing banking and commerce. And so the Bank Holding Company Act was enacted to put restrictions on companies that own banks to prevent this concentration of economic power, and to restrict what the entire kind of holding company could do, what the bank holding company could do. Because as we know, what banks can do is highly restricted, but now what bank holding companies can do becomes restricted. And it was put under the Federal Reserve Board. And I do ask this question, these concerns that led to the creation of the bank holding company, do they seem to be concerns today? Because obviously, if we look around, we see very large institutions, and we certainly see them crossing state lines, although we continue to not see the mixing of banking and commerce, or mostly we don't see the mixing of banking and commerce. A bank holding company becomes limited to only engaging in certain activities, just like we know banks are only permitted to engage in the business of banking. Bank holding companies can only engage in the business of banking and activities that are so closely related to banking as to be a proper incident thereto. And this applies to all the companies under the parent company, which it means if we have one company that owns a bank and then they own a non-bank company, that non-bank company is subject to these same restrictions. And so it stops any company that is a bank holding company from owning, say, a manufacturer or any kind of company that does something that is not closely related to banking. And we'll talk a bit more about many of these concepts as we get on, but it's something that as a compliance person or, a compliance person or having that role in your organization is that you have to be mindful of what activities are legally permissible. If some idea comes about as to something that the bank or an affiliate can do, you need to be mindful as to whether it's legal, because it's not like a general corporation. Bank and their affiliates can't just engage in any activities. They must fit within these requirements. We did read a case about the Bank Holding Company Act and some challenges to it, because one of the things about the bank holding company is that it only applies to certain institutions. There are certain exemptions. And originally, one of the exemptions was a one bank holding company. It was decided when the law was enacted that if a company only owned one bank, that isn't what the concern was. So they were not subject to the Bank Holding Company Act if there was only one bank under the structure. But as time went on, it became clear that this was too big of a loophole. And in the 70s, that one bank exemption was removed. But what we see, and what we often see in banking law, is that the change in the law said this only applies after essentially June 30th, 1968. If you are a one bank holding company and you've been exempt from the Bank Holding Company Act under the original version, you can continue to operate as you have. And this is referred to as a grandfather provision. The reason this is done is because otherwise all of the one bank holding companies out there would have to divest immediately of anything that didn't fit the requirements for bank holding companies. But what we always see then is some kind of a challenge as to, who does this apply to? And that's really the point of the case, is to introduce this idea of a grandfather provision in the law. And so it's another thing that as a compliance professional, you have to sometimes read, the whole law, because it can say one thing and then there can be a series of exceptions such as for one bank holding companies that existed prior to June 30th, 1968. And it also rather shows how in this particular case, this one activity, a courier activity, which is considered part of the business of banking or something allowed under a holding company structure today, but it was moved outside of the bank and it hadn't been established yet to be permitted under a bank holding company. And so the question was whether or not this one bank holding company got to take advantage of this particular provision. And I think it well illustrates the importance for compliance professionals, not just to know the law today, but really to know what's going on in Congress, what's going on in the agencies with the rules. Because if you're taking actions based on the law today, you may be losing out if the law is changing tomorrow. And that is in fact sort of what happened in this case, because this particular holding company was not able to rely on the grandfather provision because of the actions that they'd taken during the course of this change being made to the Bank Holding Company Act. So we will definitely talk more about bank holding companies, but this is just to kind of introduce this idea that it's not just the bank that's regulated, it's really a company owning the bank and all companies under that umbrella. What I really think is the most significant modern piece of banking law is the Gramm-Leach-Bliley Act, or it's often referred to as the GLBA or the GLB Act. But this was the law in 1999 that removed the barrier between banks, bank holding companies, and investment firms and insurance companies. And so it repealed those parts of the Glass-Steagall Act that prohibited the affiliation. So this does not mean that a bank can engage in insurance activities or securities activities. What it means is that under the bank holding company, there can be insurance companies, companies that underwrite and sell securities, and banks, that all of these can be in the same large company. And or holding company is actually not the individual companies, but the holding company. And this goes back to the first question as to the concern with the size of financial companies. This really led to the big financial companies that we see today. And it comes under this category, which was a new type of holding company called a financial holding company. And so to be engaged in these greater activities, a holding company has to elect to be a financial holding company and meet a series of requirements, which we will talk about in the future. But this was probably the most significant change that we've really ever seen. Just the idea that an insurance company can be affiliated with a bank, can be affiliated with an investment firm. It also created, for the first time, federal privacy laws that dealt with something other than the government's access to your information. So prior to 1999, there was no federal law that restricted the sharing of your financial information among private companies or individuals. And I feel like I keep saying this, but in a future module, we'll talk in great detail about the financial privacy laws. So as we saw with the Bank Holding Company Act, bank holding companies can only engage in the business of banking and the activities closely related to banking. With these financial holding companies, the way that we get to the point where these companies can own insurance companies and investment companies is that they can have companies that engage in activities that are financial in nature or incidental to such financial activity. And so this is really where we see the growth in these large financial companies. But it is still financial activities. It is still money and numbers. So you can still not have an affiliation of a bank and a manufacturer or a retailer. And so we still have to always be mindful of kind of what is going on and whether it is proper within the bank or its affiliates. Another piece that came out of this was the fact that we have these big companies now that have all these different activities. And in 1999, it was decided that functional regulation was the best way to deal with this, which means that the SEC will regulate the part of the company, the financial holding company, that deals with underwriting and securities activities. Bank regulators will deal with the banking aspects, and state insurance regulators will deal with the insurance aspects. And what we see is that this means there are all these silos. There is no one looking at the whole company, really. Theoretically, the Federal Reserve Board always looks over the financial holding company, but they were really pretty hands-off on the activities that were outside of kind of their expertise. And so this is something that we see changing in the Dodd-Frank Act, which is the last kind of major piece of federal banking legislation. The Dodd-Frank Act was enacted after the financial crisis of 2008. And it was a result of, I suppose, a lot of things, but one of the common thoughts was there was no one looking over these big companies and looking at the whole picture, and really no one looking over the whole economy. And so it created the Financial Stability Oversight Council, which is a federal agency that has the ability to look at non-bank financial companies. And it put all of these increased authorities under the Federal Reserve Board. And it said that if there were really large non-bank firms, which could be an insurance firm or an underwriting or a securities firm, the Federal Reserve Board could look at them in depth in the same way that they look in depth at banks. In reality, no one wants to be in that place, and any companies that have fallen into that category have taken steps to get out of that category, but it is still there and it's in the law. It also created more requirements related to capital and liquidity and the ability of the Federal Reserve to, prudential is sort of a supervisory word, that the Federal Reserve Board had the authority to require capital and liquidity requirements of any kind of large financial firm that the Federal Reserve, through the Financial Stability Oversight Council, thinks could impact the economy as a whole. And that as we see other types of companies other than banks playing a bigger role in the economy, it was realized that just regulating banks was not enough to keep the economy sort of afloat. It also brought in derivatives regulation. So in this period prior to 2008, we saw a lot of new creative financial products and arrangements, and they were all sort of contract-based, which was not really part of traditional banking regulation. Traditional banking regulation was really balance sheet based and really looked at traditional assets and liabilities. But in the Dodd-Frank Act, it was decided that contractual obligations are really just as important as any other type of liability. And so there were provisions put in place to include them in banking regulation. The Dodd-Frank Act also created the Consumer Financial Protection Bureau and included mortgage reforms, because a lot of the problems in the economy flowed from improper mortgage activities. And a lot of it really came from consumer issues, and it really shows how consumer events really drive the economy. So there were a lot of consumer protections, including the creation of yet another federal regulatory bureau. And we will talk about that more in another module as well. But since we were creating a new bureau, and we already have quite a lot of federal banking agencies, the Dodd-Frank Act did merge the OCC and the OTS. So we sort of stayed at the same level of regulators. But it does create potentially for the larger national banks a fourth regulatory agency, the Consumer Financial Protection Bureau, as well as the OCC, the FRB, and the FDIC. So this is kind of, I guess, the end of the overview that will give us a place to put in some of the other financial compliance laws that we will be discussing throughout the semester. But the book does talk about some of the themes that you hopefully have already started to see and that will shape regulation. One is this concern of mixing banking and commerce, which continues today and does restrict what banks and other financial companies can do. It limits them as they try to be competitive in the marketplace to certain activities. The fact that, banking is a limited entry, that there is a chartering process. There's no right to start a bank. You have to meet a lot of barriers. The idea of the state and the federal regulatory scheme, the fact that you can charter a state or a federal bank, and that oftentimes individuals will try to figure out who has the better regulatory scheme, which is called arbitrage. The concern of a concentration of economic power. You may think that that's not much of a concern, but it really is. And as we look at mergers and acquisitions and how that is done, that continues to be something that banks and their holding companies have to be thinking about. Safety and soundness is a concept that we will be talking about throughout the semester. It's kind of the general rule for compliance and risk analysis, that, banking regulation requires that banks operate in a manner that's safe and sound, and compliance is really the key to safety and soundness. And finally, this grandfather provision idea, this idea that oftentimes there are exceptions in the law for those who are already doing something if it becomes prohibited in the future. So I just wanted to put up a final slide here because I think it is kind of interesting, and this is from a few years ago, but the numbers are still interesting, just to show sort of the size of the largest institutions and their consolidated assets, which are in the trillions. And so, although these ideas of, avoiding the concentration of economic power are a part of our regulatory and compliance scheme, we certainly have quite large institutions. And it is a compliance challenge that we have to be mindful of, because we're seeing more and more laws and requirements that split out based on the size of the institution. And that is something we didn't see before when all institutions were somewhat of a similar size. But that is something to be aware of when you're looking at what applies to any particular institution. So that is pretty much the lay of the land for the major pieces of federal banking legislation. And in the next module, we're kind of start to get into a little bit more detail. So let me know if you have questions.